Hi CA students, let's revise CA Final AFM Chapter 13 Business Valuation. Practical question 9. With the help of the following information of Jatayu Limited, compute the economic value added. Capital structure is given, equity capital 160 lakhs, reserves and surplus 140 lakhs, and 10% debentures of 400 lakhs. Cost of equity 14%, nothing but the KE, and financial leverage they've given 1.5 times, then income tax rate of 30%. So economic value added is nothing but no PAT minus the capital charge. No PAT is net operating profit after tax minus the capital charge, and this net operating profit after tax will be non-cash adjusted. Capital charge is nothing but total capital or the invested capital multiplied by weighted average cost of capital. So economic value added helps us find the value of a firm, not just the value of the firm, it's the value how much the company has created beyond its cost of capital, like how over and above the cost which the company has incurred and how much the value the company has created. So this no PAT is net operating profit after tax, and we are reducing the cost of the capital invested. So using the capital, how much extra value we have created, that's what is EVA is about, economic value added. Okay, going further with the first, as we can see, we need no PAT, then capital charge. Total capital we know it is that 160 plus 140 plus 400 will give us the total capital, and weighted average cost of capital we have to find out. So weighted average cost of capital is nothing but the KO, which KE multiplied by E plus D plus KD multiplied by D by E plus D, wherein KD is after tax cost of debt. Cost of debt we have to calculate. No, they've given 10% is there. If we adjust tax in that, we'll get that KD, and then we know that debt portion is 400 and equity portion is 160 plus 140, nothing but 300. Okay, then other than that, for no PAT we need EBIT, and EBIT we have to adjust it with the tax. So no PAT will be equal to EBIT 1 minus tax rate, and this should be non-cash adjustment should be done in this no PAT. Here there is no information of any depreciation or anything, so we'll leave it as it is. Okay, now financial leverage they've given us 1.5 times. Financial leverage gives us the sensitivity of the EBIT towards EBT, so it gives us the impact of interest on the return of the equity. Okay, now EBIT divided by EBT is the formula for calculating financial leverage, and 1.5 times is the financial leverage. If the financial leverage is 1, that indirectly signifies there is no debt involved in the firm, but here debt is there, and even we can see 1.5 times financial leverage is there. So reverse calculating we can find out the EBIT, because that is required for our economic value added calculation, wherein no PAT is nothing but EBIT multiplied by 1 minus tax rate, and we know financial leverage is 1.5, and we need EBIT, and EBT is nothing but EBIT minus the tax rate, and we know tax rate also as 30%. Reverse calculating we got EBIT as 120 lakhs. Okay, now adjusting tax again in this 120 lakhs will give us no PAT, net operating profit after tax. Okay, now we have to reduce the capital charge from this. Capital charge we'll find out by multiplying total capital multiplied by the weighted average cost of capital. So weighted average cost of capital, as I told, the formula is KE multiplied by E by E plus D plus KD multiplied by D by E plus D. In our case, KE is 14%, which they've already given cost of equity, and KD we found out as 10%, Yeah, so 10% is the this thing. We should have adjusted the tax portion in it, but I don't know why they have not done that. Yeah, it's there, sorry, they have adjusted that. So 10 percentage minus the tax rate 30 percentage will give us the weighted average cost, and the E by E plus D is 300 divided by 700. 300 is 160 plus 140, so this is nothing but equity portion 160 plus 140. Reserves also belongs to equity shareholders, and 700 is nothing but total of all this 160 plus 140 plus 400, and here 400 by 700, this is the weight of debt. So which will ultimately give us the weighted average cost of capital 10 percentage. Then the total invested capital is 700, so 700 multiplied by 10 percentage, that is the capital charge. In our case it is 70 lakhs, and the NOPAT which we got is 84 lakhs. So 84 minus 70 is the value added to the firm, which is nothing but 14 lakhs in our case. Thank you.